Hello and welcome to Season 2, Episode 7 of the Talking Central Banks podcast with me, Karan Marishi. This platform is exclusively dedicated to everything central banking, monetary economics, and policy technicals for observers across the world. Today, we will be talking about former Fed New York head of the discount window department, Susan McLaughlin's testimony to the Task Force of Monetary Policy. We will also talk about US sovereign debt, financial stability, and recommendations presented. Our guest tonight is Susan McLaughlin herself. As mentioned, Susan was the head of the Financial Management and Discount Window Department at the New York Fed between 2007 and 9, when she was deeply involved in various aspects of the Fed's policy response to the global financial crisis. She also served as a senior policy advisor in the markets group and led the Fed's successful reform of the tri-party repo market between 2010 and 18. Susan had a 30-year career at the New York Fed with roles in the markets group spanning monetary policy implementation, foreign exchange reserve management, financial market structure, financial stability, lender of last resort policy operations, and sovereign debt management. She spent the first part of her career on the New York Fed's trading desk, working first in the FX reserves management and then in monetary policy implementation. Most recently, she had senior management responsibility for Treasury debt auction operations, which the New York Fed executes as fiscal agent for the US Treasury. She also managed and wound down a number of the emergency lending programs the New York Fed implemented as part of the Federal Reserve's policy response to the economic impact of the COVID-19 pandemic. Currently, Susan is an executive fellow with the Yale Program on Financial Stability. She also works as a technical assistance advisor on central banking issues with the IMF and the US Treasury, and serves as the chair of the board of directors of the West Side Campaign Against Hunger in New York City. Susan holds an MBA from the University of Michigan, Ross School of Business, and also earned an MPP from the same university. She holds a CFA designation and is a lifetime member of the Council on Foreign Relations. Welcome to the show, Susan.
Thank you. It's good to see you.
You're very welcome. It's an honor, Susan. So, Susan, you recently testified to the Task Force of Monetary Policy, Treasury Market Resilience, and Economic Prosperity of the Committee on Financial Services on examining primary dealers and the balance sheet constraint in December 25.
Mhm.
Can you please give a brief background of this testimony and why is this topic so important at this time?
Sure. The task force is a group that was set up within the House committee to educate members on a number of the issues facing key U.S. financial markets. The Treasury market, as you know, has been in focus for over a decade in terms of a concern about resilience. So we had in 2014 the flash crash, where we saw, a big intraday price volatility. Then in 2019 we had the repo rate spike, and more recently in COVID, at the beginning of the pandemic, we had the dash for cash, which really created a lot of disorder in the market and ultimately required central bank intervention. So there's a lot of concern that this systemically important market, I think not just for US investors, but for global portfolios,
Right.
is maybe not as resilient as it had been in prior times. And there's been a lot of policy work and dialogue within policy circles to come up with solutions to improve market resilience. So that's really the context for the hearing that was held. The testimony that I was asked to give was about the primary dealer system specifically, and that was really what that hearing was focused on. I think members were trying to understand, are there changes that should be made to the primary dealer system that in some way could support greater resilience of the Treasury market? As you saw from my testimony, I don't think that that's necessarily the case, and we can talk more about that. But that was really kind of the one of, I think, many hearings that they're holding around this broader issue of Treasury market resilience.
Susan, can you talk about your assessment, and I quote, There was unanimous agreement in the room that the size of the national debt represents the first order risk to the long-term stability of this critical market. A bit in more detail, perhaps, and the
Absolutely.
implications on the US Treasuries as a safe haven asset going forward.
Sure thing, absolutely. Well, I'm sure as many of your viewers will be familiar with, the U.S. Treasury market has been kind of a safe haven asset historically, and there are
Right,
a number of reasons for that. You know, Historically in the U.S. we've had very sound political stability, the rule of law, including property rights, which is an investor protection. We have a deep and large Treasury market, the deepest and largest in the world, and this facilitates easy buying and selling. So it's very easy to quickly enter or exit positions. There are relatively liquid derivatives markets on Treasury instruments that allow hedging of risk of positions in Treasuries. We have a regulatory framework that protects investors, and the U.S. has historically had a strong credit rating. So all of those factors have really made the U.S. Treasury market a go-to in times of stress for global investors. But in recent years, I think the concept of political stability with respect to Treasury market resilience has been a bit more challenging because we have this debt ceiling that's part of
right.
the law in the U.S. We've had it for a long time. The debt ceiling, actually, I was looking back at this because I was like, when was this created? And it actually was created by Congress in 1917. It's been
Right.
raised a lot, 78 times just between 1960 and 2023. Um,
Yeah.
but I think in the last couple of decades, as political gridlock and more adversarial politics have come about in Washington, this debt ceiling has become a bit of a tool, if you will, for political brinkmanship. So, we have every other year. I mean, I remember my time at the Fed, every other year we were kind of preparing for the nightmare scenario of the ceiling doesn't get listed and there's a technical default by Treasury on some of its obligations. Now, the markets and the
Right.
Treasury have figured out ways to deal with that, but it's still not a great position to be in. And I think the uncertainty that's been created by, kind of running up to the literally the 11th hour to get the ceiling lifted time after time, it's not confidence inspiring for global investors. And so I think that's been
Right.
one challenge that the Treasury market is facing. I think another issue that we really need to be careful about with respect to the size of the debt is the credit rating. So until 2011, the US was a triple A credit, no questions.
Right.
And
Right.
then over the years since then, each of the three major rating agencies has downgraded the US. So the most recent downgrade was Moody's last year. And all of those downgrades cited the growing debt burden relative to GDP and the challenging governance issues around the politicization of the debt ceiling. So I think that this is a cause for concern and definitely worth watching. Obviously, if the debt continues to grow, if we continue to see kind of these governance challenges, these trends, unchecked, could result in the future in further ratings downgrades.
But on the contrary, Susan, the US dollar makes the US sovereign debt AAA, and no matter what the rating agencies say, don't you think?
Well, so I think it would be yeah, we certainly get a lot of benefit from the status of the US dollar as a reserve currency. And there's no
Right.
indication that that reserve currency status is going to be eroded significantly anytime soon. But in the longer scheme of things, it is important. And I think, again, even a sound credit, if there's instability, if the debt becomes seen as really unsustainable, reaching higher debt to GDP ratios,
Right.
that could influence global investors anyway.
Susan, you have raised concerns about the quantity of marketable treasury debt growing faster than the dealer community's capacity to intermediate it. As treasury supply continues to outpace growth of dealer balance sheets, what potential long-term impacts do you see on auction efficiency and the government's overall cost of borrowing?
Yeah, so we've seen that in other countries that as debt to GDP increases, the sovereign credit rating tends to decline, and that means
Right.
higher borrowing costs, both in terms of the larger base of debt that the government is paying interest on, and also in terms of the rate that the debt can it be issued at. There's a great paper out from Brookings by Nellie Liang and Pat Parkinson a few years ago that documented the decline in the dealer's capacity to intermediate treasury debt. They showed that broker-dealer inventories of Treasury securities fell from 10% um, in I think 2009 to 3% in the following decade, um, which means that dealers are holding in their inventories, they're holding a smaller share of the outstanding debt, right? So this is suggesting that dealers have, are becoming a smaller fish in a bigger pond, right? So intermediation capacity is not really keeping pace with the size of the debt. Um, and I think that that's really a concern. And of course, there are things that are happening now. I mean, central clearing, which is a mandate that was put out by the SEC. I think the final rule was put out in December 2023, is now being implemented. So at the end of the year, we'll see central clearing expand for cash treasury transactions, and then repo transactions that are eligible for the rules coverage will go into central clearing the middle of next year. So that's one big effort that's been made. The reform of the ESLR, the supplementary leverage ratio, which is a capital requirement for for bank holding companies, is being reduced a bit in the U.S. to provide a little bit of relief on low risk assets like treasuries. And then, I think the capital requirements, should help a little bit. The central clearing should help a little bit. The Treasury buyback program that was introduced last year, which allows primary dealers to sell back treasuries that are less liquid to free up balance sheet to intermediate new issuance, can help a little bit. But I think none of these is a silver bullet, right? So, you could imagine that there might be a level of debt at some point that none of these measures alone or even in combination could really help to address. So that's definitely a concern. I mean, I was looking at the data. The market value of marketable treasury securities outstanding was 6.1 trillion at the beginning of 2009,
Wow.
and it's risen to 15.7 trillion a decade later. So that was 2019. As of the last monthly public debt statement, it's 29.3 trillion. So that is really
Yeah,
very,
that's huge.
yeah, huge growth, probably not
Mhm.
sustainable at that pace. In terms of, so that's, I think, obviously cost of borrowing would be affected. The other part of your question was about auction efficiency. So I would say the auction infrastructure is already operating at pretty full tilt, given the number of auctions that are conducted each week. So when I first joined the Fed in '93, a long time ago, the average auctions per week by the Treasury that the New York was facilitating were 3 auctions a week. It's now 8.5. So that reflects, more securities, larger debt. Um, and I think while the technology infrastructure, it is constantly updated, maintained, it's still 20 years old. So in fact, the Treasury is going to be rolling out, I think an official said recently publicly that the Treasury plans to roll out a new auction system later this year. So that's good. But you could imagine a size of the debt at which, operational strain is really intense, particularly if we don't really rethink the technology that we use to operationalize the auctions and to settle the debt. So yeah, I mean, I think, it's a long-term concern, I think the operational efficiency, but it's a concern.
Right. Talking a bit about the SEC's Treasury clearing rules, Susan, which will take effect in 26 for cash and 27 for repo. This is expected to greatly expand the scope for balance sheet netting. Can you please explain how this regulatory shift will reduce risk and help financial stability?
Sure. I mean, I think the basic concept of balance sheet netting is that dealers that are affiliated with banks, bank holding companies, subject to capital rules for banks, can net offsetting exposures that meet certain criteria so that they can have less balance sheet on which the capital charge is assessed. So that frees up space for them to take on more exposures. Central clearing, I think the idea of central clearing, right now it's possible for a dealer to net a repo with the same counterparty if it has like the same maturity date, same settlement date, it was settled on the same settlement system. But a lot of the dealer's activity is actually lending to one party in repo and borrowing or, purchasing from another counterparty. And so that cannot currently be offset. I think the power of the central clearing is that in a CCP, all of the trades that are submitted by the dealers are novated to the CCP, which means the CCP takes on the role of the dealer's counterparty. So we always say the CCP is the buyer to all sellers and the seller to all buyers. And so if I'm a dealer and I've done a trade with you and I've done an offsetting trade with this other person today under the capital rules, I can't net that exposure. But tomorrow, if both of those exposures are ultimately to the CCP, I can net them. So that's, I think, where the central clearing benefit really comes in. This is particularly important for repo because I think my understanding is that cash trades, just outright purchases and sales of Treasury securities, can actually be offset within certain conditions for the purposes of the capital rule, but repo cannot. So there's a lot of repo activity that will be able to be netted if it's in the central clearing, uh, the central counterparty and subject to this novation.
Right, right. So, what is significance for the desk uh, and the impact you see of this on the market in general?
So I think CCPs offer a lot of benefits, obviously, benefits and risks both, and we can talk about those. I mean, the CCP offers
Mhm.
this opportunity to net transactions, so it's going to probably add some capacity to dealer balance sheets and
Right,
increase capacity for intermediation. While the desk is not typically operating as a two-way participant and it's not part of the CCP today, we do have one CCP in the US. It's the Fixed Income Clearing Corporation's Government Securities Division, which is an interdealer central clearing counterparty for interdealer trades in treasuries and other government securities. Um, the Fed is not currently a member of that, but certainly anything that increases dealer capacity to intermediate treasuries is a positive thing for the desk because it also, means that the desk has that much more capacity with dealers to conduct its operations.
right.
Sorry, that's my.
Now that it is clear that primary dealers play a critical role in both monetary policy implementation and treasury debt underwriting, Susan, can you give the audience a glimpse of their role in maintaining liquidity and risk from your experience on the ground? Maybe you can talk about a real-time event that unfolded while you were at the desk.
Yeah, so I'll answer this question from the perspective of the primary market, which is where most of my experience at the Fed was.
Right.
Primary market meaning the point of issuance through auctions, which the
Hmm.
Fed, as you noted, helps to run along with the Bureau of the Public Service for Treasury. So without naming any names, I remember one multi-day period of market stress in which several primary dealers did not step up and bid at auction for their pro rata share of securities. So primary dealers face a requirement that in every auction of Treasury securities, they have to bid for their pro rata share. So we have 26 primary dealers today. That means that each primary dealer must bid for 1/26th of the amount that is being announced as being issued by Treasury in that auction. And, there's some risk with that, right? If markets are moving quickly, you might submit your bid at one price. By the time you get the award, markets moved away from you and you might have lost money. So it's a hard thing to make that commitment to always be there, but it's something that is required of primary dealers in order to be a primary dealer. But we did have this period, a multi-day period of extreme market volatility where we saw that a few dealers were not coming into the auction. And we had to call them and read them the riot act, basically, that, this is your responsibility as a primary dealer. I mean, the Fed has been known to suspend or even eject dealers that have not consistently met this responsibility for Treasury.
Right.
It's that important. So that was definitely one. I think another, like just more kind of common occurrence, not frequent, but every so often when I was running auction operations at the New York Fed, we'd have a case where a dealer missed an auction, not because they didn't want to come in, but because maybe the main trader was on vacation and the backup, wasn't aware of what to do, or there was an operational
Right.
problem at the firm or something. So, even in those fairly innocent instances, I had to call senior management and ask them, grill them, like, why didn't you come to the auction? What happened? They had to write up an explanation and a remediation plan that they shared with both the New York Fed and the
Hmm.
Treasury. We take it really
Right.
seriously. Why did we take it so seriously? It's because that pro rata requirement really mitigates the risk of an auction failure. So the Treasury by having now 26 primary dealers who guarantee that their bids are going to cover the full amount of issuance, even if nobody else showed up to the auction, they know that they can sell all of the securities that they have announced they're going to sell. And
Right.
a reputational importance. It's a confidence issue. So if there was a failed auction where the amount of bids were not sufficient to cover what had been publicly announced to be sold, that would be a big problem. I think it would some people have called it a catastrophic event for global financial markets. It certainly wouldn't be, it would be very destabilizing. So, I think the treasury market is so important to global financial markets because it's a source of pricing in the markets. And it is, it does have this kind of safe haven status. So if you had a failed auction, it really, I think, would raise a lot of questions and would really affect liquidity and pricing conditions around the world.
So, Susan, do you have an example? For example, something that happened during the GFC or the COVID-19 pandemic. I mean, in your experience that you could probably share with the audience.
Well, I have to be careful,
Yeah,
under the code of conduct. Even though I'm
right.
retired, I still have a duty
Mm,
to the Fed to not name names and to be
right.
circumspect. But I mean that multi-day
Mm.
period that I referred to was during the global financial crisis. Um, and it's highly unusual that primary dealers would intentionally not show up to an auction. I mean, it's a very, very serious responsibility that they take seriously, that the Fed takes seriously, that the Treasury takes extremely seriously. So, I probably can't, name firms, but that was definitely I mean, that's really the only time in my career I saw that happen.
Very insightful discussion indeed, Susan. That brings me to the question about the primary dealer definition, Susan.
Hmm.
What are the qualifications of being a primary dealer apart from being a GSIB? Importantly, what is the thinking behind the selection process of such entities?
Yeah. So, you don't actually have to be a GSIB to be a primary dealer.
Right. Okay.
And there's a primary dealer policy that's posted on the New York Fed's website that actually has a great amount of detail if your viewers want to see or understand more about this. Um, but basically, the firms that are selected have to be able to demonstrate an active, sustained, significant presence as a market maker in the treasury market in both directions. So they have to really, have a strong market making presence. They have to be able to meet minimum capital standards that are spelled out in the policy that's on the New York Fed's website. They've got to have the capacity to provide timely and high quality market intelligence to the desk because the trader analysts on the desk of the New York Fed conduct important briefings to policymakers on a daily basis. And so they're talking with a wide range of market participants, buy side, sell side, US, foreign. And the primary dealers, because of the activity they see, not just in the treasury market, but also in other markets, are a very valuable source of intelligence that they have to rely on. Primary dealers also need to be able to comply with market best practices like the treasury market practices and the foreign exchange global code. And that is a way I think that through those primary dealer relationships, the Fed can foster market integrity and compliance with those good practices. Because if those large players are following those practices, they're going to require that of their counterparties as well. So that's a really important responsibility they take on. There's also a number of operational requirements that a primary dealer has to be able to meet. Having, the operational capacity to buy and sell in scale at any time, with the Fed, which has its own proprietary trading system. So the Fed does not rely on public platforms. They have a proprietary trade system that dealers need to be able to connect to and operate in. They have to be a member of the Fixed Income Clearing Corporation, the Government Securities Division. They have to have a robust compliance program so that we know that they're managing their risks well and they're a suitable counterparty. Or I say we, the Fed. I'm retired now, but it's an old habit. Um,
Mhm.
Primary dealers also have to
Mm.
have a disaster recovery capability, usually meaning a second site from which they could operate if their main site had an operational issue or, that the power grid went out or there was some other kind of natural disaster type of event. Um, so there are a lot of requirements that primary dealers must meet. And I think the Fed has gotten criticized at times for, well, why are you dealing with only the biggest firms? Well, the biggest firms, the biggest market makers, are the ones who can actually transact in the sizes that the Fed needs to be able to transact in to effectively implement monetary policy operations. And there has been, I mean, the primary dealer policy that was published in 2016, which I actually led the formulation of, we actually did reduce the entry requirements in terms of the minimum capital requirements a bit to allow a broader range of players, but there is some kind of minimum scale that you need to be able to perform that role effectively as a two-way market maker. So, there are a lot of requirements. Some of them, really try to mitigate counterparty risk exposure for the Fed. And they really also are looking to ensure that the primary dealers are resilient enough to support monetary policy operations, both in normal and stressed market environments. I mean, that's really important. People forget, I think sometimes, like the primary dealers, although they're very identified with Treasury and they have this responsibility for coverage at Treasury auctions, they're first and foremost the counterparties of the New York Fed or the Fed for monetary policy implementation. So that's really how the primary dealer system started. I think, after the Fed established the system, which served monetary policy operations, it was subsequently leveraged to support Treasury issuance as well, because the Fed is also the fiscal agent to the Treasury.
Right, right. By the way, Susan, given your testimony, why do you think that the primary dealer system should not be open to other types of firms beyond banks and broker dealers?
Yeah, I think it's just that banks and broker dealers are the only ones that are performing this two-way market making function in the treasury market. And so, you know, again, like that two-way market making presence is crucial to be an effective counterparty to the Fed because depending on the directives from the Federal Open Market Committee to the desk may at any time either need to buy or sell or, do repo or reverse repo. So they need counterparties that can pretty quickly accommodate trading in either direction. And so, if you're not a two-way market maker, you're really not well suited to be a primary dealer and meet the needs of the Fed for monetary policy implementation. A hedge fund, for example, it's trading, but it's not maintaining an inventory. It's not making markets for customers. That's really not an appropriate business model for the primary dealer
Right,
responsibility.
right. So basically, you mean, Susan, correct me if I'm wrong, that they should be holding those securities on their balance sheets.
And should be making
Mhm.
markets, pricing securities, have an active customer base. Because, of course, if a primary dealer is buying securities from the Fed or selling to the securities of the Fed, they also may not have all of that in inventory. So they may need to be able to source them from their network of customers as well.
Right, right. Hypothetically speaking, Susan, it can be assessed that a greater number of dealers will add to the existing capacity. But do you think this may lead to any potential risks to the efficiency of monetary policy implementation, in your view?
Yeah, I mean, I think I would, for purposes of this question, I would maybe distinguish between Treasury issuance and monetary policy implementation. So, in my testimony, that was one of the questions that the committee had was, would adding more firms to the primary dealer list help? I think it helps in some ways and doesn't help in others. So for monetary policy implementation, most of the existing significant market makers are already primary dealers, or they have chosen not to apply to be primary dealers. So the firms that are left, are maybe too small to be able to play that role effectively. So for monetary policy implementation, I don't know that it really does much of anything. However, expanding the list of dealers that are subject to the pro rata requirement for treasury issuance could be extremely helpful. For primary market underwriting, the more the merrier, I think. Like the more dealers you have to be able to split the responsibility of covering the auction, the better. I think the challenge is that to date, the largest market makers in the treasury market have been very well suited both for as Fed counterparties for open market operations and to support treasury auctions. And at this level of debt, and as the debt grows larger, we may be reaching a point where those interests are diverging. So more dealers may not help the Fed implement monetary policy, might actually even complicate it in some ways. but more dealers would add capacity for treasury underwriting. That would be very helpful in mitigating the risk of auction failure. So it could be that an additional set of counterparties beyond the primary dealers might be helpful for treasury to establish to mitigate this risk. And I suggested that in my testimony.
How much capacity can be created with these measures realistically, Susan? And will this be sufficient? This is because Treasury marketable debt outstanding grew by $1 trillion just between July and October
Yeah.
25. And as you mentioned in the testimony, and there are no signs of it abating at this time.
Right. Absolutely. Yeah. No, I mean, I think this is not a problem. This problem of intermediation capacity and market resilience is not a problem that has just one solution. I think there's probably a mix of measures that are needed to address it. And many of those measures are coming into play already. So, we talked about central clearing. Liang and Zhu just updated their paper out of Brookings, and they estimate that the repo clearing mandate could increase balance sheet capacity of the dealer community by as much as 1.3 trillion. Then we have the recent rule change for the ESLR, the supplementary leverage ratio for bank holding companies. So six of the primary dealers are GSIBs, and they have the most, probably the greatest balance sheet capacity among the primary dealers. And the federal banking regulators estimated in their memo that the SLR changes could free up as much as 2 trillion in capacity. I think that might be a
Okay.
slightly optimistic estimate, but 2 trillion, I mean, and then we don't know what things like all-to-all clearing could do. That's not
Mm.
established yet, but certainly, there's some potential there. So I think, all of these things are helpful, but when you hear, 1 trillion, 2 trillion, like say that you had measures that brought 10 trillion additional balance sheet capacity. Just from February 25 to February 26, the debt increased 2 trillion. When I say the debt, I mean marketable debt held by the public. So
Right.
you can imagine that there's going to be a point if the growth is unchecked that no combination of measures is really going to help address the resilience issue. And that's really why the first order issue is to get a control over the debt. But as you
A
say,
bit out of,
no
yeah.
no signs that that's happening anytime immediately.
On the question of liquidity problem versus solvency problem, Susan, during crisis, what is the understanding between the desk and the primary dealers, who are also the market makers? This pertains to the distribution of liquidity and the implementation of monetary policy.
Yeah, so I think there's a couple dimensions maybe to this question that you're asking. So let me try to address
Mm.
both of them. I
Right.
think if you're asking, do primary dealers have to be solvent? Yes, they do, and that's actually stated in the public eligibility criteria on the New York Fed's website. The primary dealer policy lays out minimum capital standards that are intended to be an ongoing standard for primary dealers to constantly meet. So I think there
Mm.
would always be a concern if the primary dealer was falling below those standards. There's a credit risk team at the New York Fed that actually monitors this quite closely. If you're asking, do primary dealers have to stand ready to participate in open market operations and bid for their pro rata share throughout a range of market environments? The answer to that is also yes. So there's no real allowance for market stress. And when firms sign up to be primary dealers, they are making a commitment to be there as a counterparty to the desk and to be there as an underwriter for treasury debt, whatever the market environment. And so that's really the understanding and it's spelled out very, very clearly in the eligibility in the policy and the eligibility requirements. Um, but of course, primary dealers are private firms with their own risk assessment and management processes. So they're going to adjust their activity as market risk adjusts. This could mean that a firm might curtail the provision of liquidity to customers in a period where their own liquidity risk is increasing.
Right.
This is exactly why the primary dealer policy has these requirements to be there for open market operations and for treasury debt underwriting in all environments because, it's recognized firms have to adjust and their risk tolerance is going to change over time with market conditions. But we can't afford to have kind of volatility and participation in operations to support public sector goals.
Right. Very interesting, Susan. You talk about the all-to-all platforms for the trading of debt securities, including corporate debt and synthetics, Susan. Apparently, China has a very innovative platform called the China Interbank Bond Market, or CIBM, which is also an all-to-all platform boasting of outstanding volumes of over $20 trillion in China.
Wow.
And this platform includes all kinds of market participants and fixed income instruments and helps provide liquidity to both the primary and the secondary markets. So, Susan, do you think this kind of a system would be beneficial to the US debt market given its size and maturity?
So I can't speak to China's system specifically. That's super interesting to know about. I'd love to learn more about that. So I don't know enough about kind of the microstructure of that market to say how fit for purpose it would be for the treasury market, but certainly I think there's a role for all-to-all trading to play for at least some share of treasury market activity. We do see
Right.
platforms like this, these all-to-all platforms in the US and markets like the corporate debt market. Any amount of direct buyer to seller transactions would take pressure off the dealer balance sheets. I don't think it's going to be a cure-all. I can't imagine that all treasury market activity over time could migrate to an all-to-all platform. Less liquid issues, for example. I think all-to-all works really well when you have securities that are highly likely to be both in demand, as for buyers and for sellers. And there are some less liquid, deeply off the run securities that might not fit that criterion, although they might benefit from all to all. So, it's
Mm.
probably the case that it would be, some subset of treasury market activity that would best fit on an all to all platform. But I certainly think it's something that should be pursued.
Right. Susan, there has been a 2024 SEC rule for central clearing pertaining to treasuries. This is done to reduce the portion of uncleared bilateral from 84% currently to 5% eventually, increasing transparency and risk in the treasury market given its size and significance. Do you think that central clearing operations can be open to non-bank entities? And if not, how and why will this be different to the primary dealer framework, in your opinion?
So central clearing is already open to non-banks. In fact, some primary
Okay.
dealers are non-banks. So fewer of them than there used to be. We used to have, I mean, I think when I first joined the Fed, I could guess maybe half of the primary dealers were independent broker dealers that were not affiliated with a bank. That's really changed over the last few decades because we've had a lot of consolidation in the financial industry. So many government securities dealers have actually been acquired by banking organizations, but there are still a few independent broker dealers that are on the primary dealer list. Um, so we do have non-bank participants in Treasury, repo, and derivatives clearing today. There are many non-bank dealers that are members of the Fixed Income Clearing Corporation, and also participate in clearing of derivatives on Treasury instruments in like CME, ICE Clear. So I think the non-banks are already going to be part of this mandate. In fact, many of the counterparties that will be brought into central clearing through the eligibility under this rule change are non-bank institutions.
Question that comes to my mind, Susan, is that will there be any impact of this rule on the LOLR function of the New York Fed? Any changes you expect on the current framework?
I don't think so. I mean, the way I think about it is, the rule really pertains to CCP members who clear Treasury securities and repo. So the rule requires that all of those CCP members' activity, including activity with counterparties that are not CCP members today, must
Right.
come through the CCP. And the goal of the rule is really to support Treasury market resilience and mitigate systemic risk by addressing the inconsistent and opaque risk management practices associated with non-cleared trades that could serve as a channel of risk propagation to the broader financial system. How does it do that? The rule will reduce individual firms' counterparty credit risk through this process of novation to the CCP. So the
Right.
CCP will be well managed because it'll be a designated financial market utility. It already is under US law. which means it's systemically important and it's subject to a very high level of supervision by, depending on whether it's a CCP that's clearing securities, that would be overseen by the Securities and Exchange Commission, or if it's a derivatives or commodities exchange or clearing organization, it would be overseen by the CFTC. The Fed is
Right.
also an umbrella supervisor for those systemically important institutions, which means that they can participate in exams and have a role in the oversight of those systemically important CCPs. So the CCPs, you know, the CCP will be a stronger counterparty probably than most firms that the dealer is dealing with today. It will have financial resources in terms of capital, in terms of liquidity, um, and risk management practices that are very, very stringent. So that helps individual firms in terms of counterparty credit risk. It's also going to bring a lot of bilateral repo activity into clearing. And as you probably know, bilateral repo activity, a lot of it in the US is currently not margined at all. Um,
Right.
Anything that's going through the CCP is going to be subject to both initial and variation margin. So that will improve the risk management of those trades. It's going to provide greater capacity to mitigate the risks of runs and fire sales through the CCP's default management process and a public rule book. So one important feature of CCPs is that they're required to have a public rule book and spell out how they would manage the default of a member. And this is a really important thing because everyone in the CCP understands how, if a member fails, how they will be made whole, which reduces their incentives to run in the event of a member default or to fire sell assets. Also, the CCP has resources to finance the liquidation of the defaulting members' positions over time rather than having to fire sell their positions on that day or the day after.
Okay.
So, in that way, it's really a stabilizer. We actually saw during the global financial crisis that CCPs had some really stabilizing effects on the market after in the wake of Lehman's fall.
Mm.
And they were able to manage the liquidation of a lot of the Lehman positions in the CCPs in a very orderly way that didn't really result in any run fire sale dynamics, which, in an
Mm.
already very stressed market was extremely helpful. Um, I think the CCP, obviously we've talked about the incremental addition that central clearing can provide for balance sheet intermediation capacity in the treasury market. So that's a positive thing. Of course, nothing good comes for free, right? And there's some offsetting risks. So concentration risk and operational risk would be things to point to. Because treasury securities are settled on a gross instead of a net basis, like derivatives are, there's more liquidity that's required to settle a dollar of treasury exposure than notional derivative exposure. And I think, a question that regulators will have to be very carefully monitoring is, are the liquidity resources in the CCP adequate to manage, out of a default scenario or to manage the liquidity needs and stress? But I think there are a lot of positive things that will be brought by central clearing. Also, centralizing more of the activity in a single clearing point allows regulators and the CCP management to understand much more of the market activity. So right now, it's very hard to understand. Until recently, it's been very hard to understand what was happening in bilateral repo because there was no data. If that activity is
Right.
coming through the central clearing um, agency, there's a lot more, kind of a bigger share of the market that's subject to a picture. And I think that's very helpful for regulators and policymakers.
Very interesting, Susan. Finally, in crisis, GSECs are probably the only game in town, and therefore collateral constraint is often a problem for the system as a whole. So, among the Treasury, New York Fed, the desk, and the primary dealers, what is the understanding regarding an alternative collateral apart from the GSECs if all else fails, including OMOs, LOLR, and CLFs, etc.?
Yeah, and in fact, we saw that even Treasury securities weren't necessarily the safe haven in
Right.
COVID, right? There was a lot of
Mm.
illiquidity and disorder in that
Mm.
market because of the dash for cash. So the rules
Mm.
for collateral in the U.S. framework for the central bank are very clear on collateral. The Fed conducts open market operations in government securities only. So the language of Section 14 of the Federal Reserve Act says the full faith and credit of the United States government. So any instrument that's
Right.
backed by the full faith and credit is
Mm.
eligible for use in open market operations, but not other types of assets. Then we have Section 10B of the Federal Reserve Act, which allows the Fed to lend to banks against a wide range of collateral that's on banks' balance sheets, generally investment grade collateral, but including not only securities, but also loan portfolios. Then we have Section 13.3 of the Federal Reserve Act, which you know, stability, and which got a lot of attention in the GFC and again in COVID, that provides the Board of Governors authority in unusual, when they determine circumstances are unusual and exigent, to lend against even a broader range of collateral potentially. Um, there are a lot of controls in place and more that were put in by the Dodd-Frank Act in 2010. Um, so that lending under the Section 13.3 emergency authority must be broadly based. So you can't use it anymore to lending to a specific firm. You can't use it for insolvent borrowers. The lending reserve bank must be adequately secured by collateral, which has always been the case, but was reiterated in the regulation. There's requirement for approval of the Treasury Secretary prior to the launch of any programs to do broad-based lending under Section 13.3. And there are also a lot of reporting requirements for the Reserve Bank. So I think within 7 days, they have to report to Congress and then continually update that reporting on who's borrowing and what collateral is being used and all of that. And the board also has to document for Congress the nature of the unusual and exigent condition that they have determined. So that's another new requirement. There's also a little known section of the Federal Reserve Act, Section 1313, that allows the Fed to lend against to anyone against Treasury or agency securities. So it's kind of a mix of the OMO collateral, but the emergency lending authority. As with other emergency lending, the board must determine that conditions in the market are unusual and exigent. The Reserve Bank would also need to obtain evidence that credit is not otherwise available to the borrower, and lack of access to credit would adversely affect the economy. So that's a pretty tall standard. Loans under Section 1313, which I don't think has ever been used, could not exceed 90 days, and the loan rate would need to exceed the secondary credit rate. So never been used. I'm not sure how many people realize that this is actually in the law. Um, I don't know that it would ever be used, given the other powers that the Fed has. But in both of these types of emergency lending, both Section 13.3 and Section 1313, the requirement for collateral is that the Reserve Bank be secured to its satisfaction. And so that means that the Reserve Bank has some discretion to define the set of acceptable collateral, but it would really do so in consultation with the Board of Governors, because that really is a policy decision if you think about
Right.
it. Um,
Right.
as we saw in COVID with system-wide lending programs where all 12 of the Reserve Banks were making loans, like the PPP lending facility. You might remember this PPP, I think paycheck provider program or something like it was a
Yeah.
COVID era program. It was put in place
Mm.
to allow businesses, small businesses in particular, to continue to pay employees. And so there was the Fed instituted a lending program that allowed those loans to be used as collateral and then forgiven. And so obviously that's not a type of collateral that's on the public discount window list, but in times of stress, there can be other types of collateral specific to the situation that could be used in emergency lending programs like that. I hope I answered
Very
your question. That
insightful.
was a very long answer, but
Absolutely. On point, Susan, as always. Well, on that note, that's all I have for today. Susan, thank you so much for taking out the time to be part of the show.
thank
It's
you.
always a pleasure speaking with you.
That's great to see you. All the
Thank you. Thank
best.
you very much.
Thanks for having
Same
me.
here. Thank you. Thank you so much, Susan.
Take care, Karen. Bye.
Take care.